Hey guys, what is up? In this video, I will be exploring StashAway's lowest risk index portfolio, which is the 6.5% portfolio, and I will also give you a crash course on bonds, so I'm sure you'll want to stick until the end of this video. But just before we begin, help me smack the like button down below. It means the world to me and I will be a very happy boy. Thank you very much. And without further ado, let's jump right into today's content. So jumping into the StashAway app, under general investing, if you look at the core portfolio, you will have the option to choose the portfolio with risk index ranging from 6.5% to 22%. When you look at the 6.5% risk index portfolio, it looks like the lowest risk investment option here. But looking at the asset classes, I'm sure it will be a little bit difficult to take in with bonds and fixed income and etc. Fret not, because I will try my best to help you understand in this video. Looking at the asset allocation, we have 6 asset classes here. Government bonds being the heaviest at 38%, followed by corporate bonds at 20%, fixed income at 20%, commodities at 15%, international equities at 6%, and lastly cash at 1%. So as you can see, the portfolio is largely dominated by bonds and fixed income, having an aggregate mix of roughly 80%, so that will be the main focus of our breakdown today. First and foremost, let's talk about government bonds. To understand this asset class, we will first need to understand what the hell are bonds. Let's use car loan as an example. I believe you can relate to it better. You borrow say 40,000 ringgit from your banks, and every month you need to pay your principal repayment plus your interest payment. And your loan could come in the form of 1 year, 3 years, 5 years, 7 years, and even up to a maximum of 9 years. In investment term, we call it a loan tenor of 7 or 9 years door to door, which is from the point of you borrowing your money and until the point you completely repay your loan. So having said that, how does this got to do with bonds? To put it in layman terms, bonds are somewhat similar to your loans, except for a few differences. Bonds are usually issued, not lent, to governments, huge corporates, and high net worth individuals, not for retail investors like you and me. Sadly, maybe one day, their interest rates are called bond yield. Their debt tenor are called maturity period, which can come in the form of 1 month, 3 months, 12 months, 3 years, 10 years, and up to 30 years. Very, very long.
That's what she said!
And in every debt instruments, regardless of loans or bonds, a longer tenor or a longer maturity period will mean more risk to the borrower, because you will never know what will happen 10 years or 15 or 20 years down the road, right? Would you want to lend your money to your friends only for him to repay you over the course of 30 years? Most probably no, right? Because there will be a higher risk of payment default. So naturally, in a normal functioning economy, the price of long-term bonds are usually lower because there are lesser investors that want to buy those long-term bonds. And as a result, longer-term bond gives you a better rate of return, or we call it a higher yield, because they are riskier in nature. However, if there are uncertainties going on in the short term, like the US-China trade war or the COVID-19 pandemic, then investors are most likely to shift their money from short-term bonds towards longer-term bonds like a 10-year or a 30-year bonds, because they are afraid of a short-term recession or that the interest rate might stay stagnant or very low in the short term. When more investors demand for longer-term bond, this will cause the price of the longer term bonds to increase, and as a result, investors will get a lower rate of return, or we call it a lower bond yield. This phenomenon is what we call the inverted yield curve, where the yield of short-term bonds are higher than long-term bonds, and it is actually happening right now, no thanks to the COVID-19 pandemic. Okay, so now you have a rough idea what bonds are. Now we can proceed to look at StashAway's 6.5% risk index portfolio. Under government bonds, the first one that we have is the iShares International Treasury Bond ETF, ticker symbol IGOV, with an expense ratio of 0.35%. This is essentially an index tracking the government bonds issued by non-United States developed markets. For example, Denmark, Sweden, Ireland, Norway, UK, and the Netherlands. Now, just to give you a little bit of context, investors all around the world look at the US governments as the safest investments because they have the strongest currency in the world, which is the United States dollar. So any government bonds or treasury bonds issued by the United States government will be considered risk-free, or technically near to 0% risk. Hence, the US Treasury bonds is used as the benchmark for bonds all around the world. So this fund is investing in the developing market. Although they are not as safe as the United States, there are still huge European countries which is far safer than emerging markets such as Brazil, China, Russia, South Africa, and etc. Looking at its historical performance, the fund has a 10.66% return in the past 1 year, 3.82% for the past 3 years, 4.7 1.77% for the past 5 years, 1.88% for the past 10 years, and 2.61% since inception. Looking at the fund characteristics, they have a weighted average maturity of 11 years. So if we compare this to the US Treasury 10-year yield, which is sitting at roughly 1.72% right now, I guess we can say that this ETF is still performing above average since they have a return of 2.61% since inception. Next, we have SPDR Bloomberg Barclays 1 to 3 month Treasury Bill ETF with an expense ratio of 0.1357%. This ETF is tracking US Treasury with a remaining maturity of 1 to 3 months, or in other words, short-term bonds. Remember earlier I said that the US Treasuries are risk-free, so for short-term bonds, their yield or return should be close to 0%. And rightfully so, looking at its historical returns, they have a 1-year return of 0.38%, 3-year return of 1.38%, 5-year return of 0.98%, and 10-year return of 0.45%. Nothing much that I can add here because the returns pretty much reflect the actual yield of short-term bonds. The third government bond that we have here is the SPDR FTSE International Government Inflation Protected Bond ETF with a gross expense ratio of 0.5%. This fund tracks inflation-linked bonds of developed and emerging market countries outside of the United States, such as the United Kingdom, France, Brazil, Italy, Turkey, and etc. This is because when the US dollar inflates or loses its value due to the Fed's printing money or reduction in the interest rate, this will result in the increase in value of the currency from the emerging markets. Looking at their historical returns, no surprise, their 1-year return stands at 8.49%, 3.5% for the past 3 years, 5.48% for the past 5 years, and 2.59% for the past 10 years. So as you can see, the return for the past 1 year during the middle of the pandemic stood at 8.49% thanks to the US dollar losing its value, which benefited this ETF. Moving on, we look at corporate bonds, which has a weightage of 20%. This is made up by the one and only iShares Floating Rate Bond ETF with an expense ratio of 0.2%. This ETF tracks US dollar denominated investment grade floating rate bonds with remaining maturities between 1 month and 5 years. Floating rate is essentially the interest rate, but it fluctuates according to the current market, and this ETF tracks US dollar denominated bonds, not US government bonds, but US dollar bonds issued by corporates or entities that may have exposure towards the interest rate. Their top holdings are mostly huge financial institutions or banks that may have bonds issued in US dollar. If we look at their weighted average maturity, it stands at 1.18 years, which is surprisingly very short term. The credit ratings of the bonds are all investment grades, with most of them being A rated, so this is a rather low risk ETF if you ask me. Looking over at their historical returns, 0.87% for the past 1 year, 2.06% for the past 3 years, 1.89% for the past 5 years, and 1.38% since inception. Oh well, looking at the measly return, no thanks to the US-China trade war and the COVID-19 pandemic. What more can I add? Moving on, we have fixed income with a weightage of 20% as well. This is essentially the Vanguard Total International Bond ETF, ticker symbol BNDX. Without getting too technical, bonds are essentially one type of fixed income securities. Fixed income securities is the umbrella name for bonds, ETFs, fixed deposits, and money market funds. This ETF tracks investment-grade fixed income investments issued in currencies other than the US dollar. In another word, an insurance against the fall of the US dollar, with an expense ratio of a measly 0.08%. This fund is largely allocated to countries such as Japan, France, Germany, Italy, and etc. In terms of credit quality, more than 70% of the bonds are of grade A and above. Looking at its historical performance, 4.63% for the past 1 year, 5.11% for the past 3 years, 4.46% for the past 5 years, and 4.24% since inception. What more can I say? If you are heavily invested in the US market, this fund could serve as a good addition to your portfolio since they are all non-US based. So this could be something for you to think about. Next, we have commodities at 15%. This is essentially the SPDR Gold Trust. In short, gold. Now, I'm not a gold investor or an expert, but when the fiat currency like the US dollar depreciates, commodities like gold will counter-react by appreciating. So this is like a hedge towards inflation. Anyways, gold is not a productive asset, so there is not much that I can add here. Moving on, we have international equities at 6% weightage, which is very small in the portfolio. I will just quickly cover this. The iShares MSCI Japan ETF EWJ is basically investing into the Japanese market. Jumping to its historical performance, 15.8% 9.43% for the past 1 year, 5.78% for the past 3 years, 8.59% for the past 5 years, and 6.13% for the past 10 years. Well, pretty impressive. The second ETF here is the KraneShares CSI China ETF KWEB, which is basically the Chinese tech companies like Tencent, Alibaba, Meituan Dianping, Pinduoduo, and Baidu. Its historical performance is nothing less than stellar. I will just let the picture speak for itself. Feel free to pause if you want to read it. Lastly, we have 1% cash in United States dollar. I mean, hedge against Ringgit Malaysia. Not too bad, right? So having gone through the 6.5% risk index portfolio, should you invest in it? Now, without knowing your circumstances, I can only say that if your goal is to preserve wealth or to diversify your US heavy portfolio, then this could be a consideration for your portfolio. The purpose of me making this video is to share you more information on this risk index portfolio so that you can make a better informed decision, and never intend to make any sort of investment recommendation or whatsoever. Alright, that is all for today's video. I hope you have gained more information on this 6.5% risk index portfolio and hopefully learn a thing or two about bonds. And if you did, help me smack the like button down below and subscribe if you haven't already. It will mean the world to me. Thank you very much. Feel free to use my StashAway referral link down below and you will be able to enjoy a management fee discount of up to 6 months. Thank you very much for watching. Stay safe, stay invested, and as usual, I will see you in the next one.